You know, when you're cleaning out your attic and you stumble across this dusty, forgotten antique clock.
Yeah.
And at first glance, it's completely obsolete. Like maybe it belongs in a museum or just as a garage sale.
Right. It looks totally useless.
Exactly. But then you wind it up and you realize it's actually a highly sophisticated money printing machine that's just, disguised in 19th century packaging.
That is honestly the perfect way to look at EZCORP.
Yeah. That is the exact feeling I got reading through the stack of sources we have for you today. Welcome to today's deep dive.
Because, I mean, to most of Wall Street, the pawn shop business model really does look like a relic.
Completely overlooked.
Yeah, totally overlooked by the major tech and finance players. Yet, while mainstream retail is struggling with all the economic volatility of 2026, this company is just quietly sitting on nearly $500 million in cash.
And expanding globally, too.
Exactly.
So for you listening, our mission today is to understand how this seemingly old-school business has turned into a financial powerhouse. We're looking at a very detailed 2026 investment analysis report on EZCORP, Inc.
They trade on the NASDAQ under EZPW.
Right. And they're a global leader in the pawn loan and secondhand retail space. But to really grasp how they're thriving, I realized I had this huge misconception about how they actually make their money.
Most people do, yeah.
I just always pictured, like, someone walking in, selling an old guitar, and the shop flipping it for a profit. But it's way more complex than that, isn't it?
It's far more complex. I mean, the retail side selling that old guitar is just one piece of the puzzle. EZCorp actually operates on three main revenue pillars.
Okay, lay them out for us.
Sure. So you have the retail merchandise sales, like you just mentioned.
Yeah.
That's selling items people either sell to them outright or, items from loans that default.
Makes sense.
Then you have jewelry scrapping, which we will definitely get into later.
Oh,
It's fascinating.
yeah, that part blew my mind.
Right. But the real engine of the business is the pawn service charges. That's the fees and the interest collected on the loans themselves.
And reading through the breakdown, this was the first massive surprise for me. The loan service charges only make up about 37% of their total revenue.
Right.
But when you look at the bottom line, they account for a staggering 64% of their gross profit.
The margin disparity there is just incredible.
64%, that's huge.
It is. The retail side is necessary, obviously, because it moves physical volume out the door. But the lending side is the absolute core of their profitability.
Because it doesn't take much to run a loan.
Exactly. It requires very little overhead to manage the loan once it's issued. And to understand why that specific lending engine is running red hot right now, we have to kind of pull back.
Look at the macro environment.
Yeah. Look at 2026 as a whole. Think about what the average middle to lower income consumer is experiencing right now.
It's a pretty tight squeeze. I mean, mainstream banks have pulled back on lending, so it's significantly harder to get a standard credit card.
Or even a personal loan.
Right. And combine that with this entrenched inflation pushing the cost of living up, and you just have a massive demographic of people who need short-term liquidity, just to bridge the gap between paychecks,
And when traditional credit dries up, the demand for alternative collateral-based liquidity just skyrockets.
Which is exactly what the report highlights.
Yeah. Because of this dynamic, EZCorp's pawn loans outstanding, which they abbreviate as PLO, hit a massive record high.
Let's talk numbers because they are wild.
Okay, so in the first quarter of fiscal 2026, which ended in December 2025, their PLO expanded by 12 to 14% year over year.
Wow.
They're holding over $307 million in active loans.
$307 million.
Yeah, it's the highest first quarter level in the history of the company.
Which is so crazy when you compare them to a standard retailer right now. Traditional retail is like terrified of global supply chain crises, right?
Constantly.
Shipping delays out of Asia, sudden tariff hikes. But EZCorp is totally immune to all of that. Their entire inventory is sourced directly from local consumers walking through the front door.
Exactly.
They don't have ships stuck in a canal. I mean, their supply chain is just the neighborhood.
It's a localized, closed-loop system.
Right. But hold on. Looking at this setup, something doesn't quite add up for me.
What's that?
Well, if they are aggressively lending to subprime borrowers, people who are actively being squeezed by inflation and locked out of traditional banking, doesn't that mean the risk of mass defaults is incredibly high?
That's the logical assumption, yeah.
So how are they not taking on a catastrophic amount of credit risk? I mean, how is this safe?
I know, it sounds like a recipe for disaster.
Yeah.
Until you look at the fundamental mechanics of a pawn loan. These are what we call non-recourse loans.
Meaning if the borrower doesn't pay, the lender can't go after their other assets.
Or garnish their wages, right?
Yeah.
If a customer borrows $100 in defaults, EZCORP does not send them to collections. They don't hire debt collectors. And they don't report it to the credit bureaus to ruin the person's credit score. The transaction just simply ends.
So EZCORP just keeps the collateral?
Exactly. They keep the watch, the laptop, the power tool, and they just move it to the retail floor.
Mm-hmm.
The secret sauce here is over-collateralization.
Meaning they're lending out far less cash than the item is actually worth.
Always. I mean, if you bring in a power drill that resells for $200, they might only lend you $60 against it.
Oh, wow. Okay.
And that neutralizes the credit risk entirely. If the customer pays the loan back with interest, EZCORP makes a high margin return on the capital.
I mean, if they walk away.
If the customer walks away, EZCORP puts that $200 drill on the shelf, sells it, and still makes a fantastic margin. They win on the redemption, and they win on the default.
Okay, that makes sense. The physical collateral is the safety net. But that brings us to the second massive trend driving their valuation right now because, not all collateral is created equal.
No, definitely not.
What is sitting in those safes right now? A lot of it is gold.
Oh, the gold dynamic is huge. The structural bull market in gold, spanning from 2025 into 2026, has completely altered the landscape for this company.
The numbers in the report are staggering. We're looking at gold pushing past $3,458 per ounce.
Yeah, with analysts from major institutions like Bank of America eyeing the $5,000 mark.
Which is insane. So for EZCORP, this acts as a massive tailwind in two distinct ways, right?
Right.
And the first one connects right back to that credit risk mitigation we just talked about. If someone pawned a gold ring a year ago, and the price of gold suddenly spikes by 20%, the collateral sitting in EZCORP's safe is suddenly worth way more than the cash they handed out for it.
Exactly. Their balance sheet basically gets safer and more valuable by the day without them lifting a finger.
That's a nice position to be in.
It creates a tremendous buffer. But the second way this helps is where their margins get truly explosive. And it involves that third revenue pillar we mentioned earlier.
The jewelry scrapping business.
Right. Think about the logistics. When a customer defaults on a gold necklace, EZCORP doesn't just put it in the display case and hope someone comes along to buy it.
Right, they don't have to wait for retail foot traffic to get their money back.
No, they gather up all the defaulted gold items, melt them down, and sell them straight into the global commodities market at the current spot price.
Which is just raw efficiency.
Yeah, and the sources show that in Q1 2026, their scrapping revenue spiked 139% year over year.
139%.
Because the underlying commodity price surged, the profit margins on that specific scrapping segment jumped from 23% up to 34%.
But wait, isn't there a risk of confusing a brilliant business model with just dumb luck?
How do you mean?
Well, they don't control the gold market. If
Yeah.
you happen to be holding a lot of gold when the price goes up, you look like a genius. But it's not because you did anything special, right?
That's a fair point. The gold price is absolutely out of their control. But the brilliance of the business model is in something called operating leverage.
Okay, unpack that for me.
They built this massive, highly efficient infrastructure to intake, process, and liquidate collateral. They have the stores, the vaults, the appraisal systems. They built a machine once.
So they already paid the entry fee.
Exactly. When the gold market surges, it just pours rocket fuel into that existing machine. They get to capture the incredible upside of a commodity boom without having to take on the massive capital expenditures of a gold mining company.
Oh, that makes sense. They aren't digging holes in the ground.
Right. They are just processing the collateral that walks through the front door.
They built the toll booth, and suddenly the traffic doubled.
That's a great way to put it.
So they are generating immense amounts of raw cash from these high-margin loans and this surging gold operation. The next logical question is what they're doing with all that capital.
And they are definitely putting it to work.
The sources show they're expanding aggressively, and 60% of their stores are now located in Latin America. But there's a really fascinating economic paradox happening down there, specifically in Mexico, that I want to talk about.
The situation in Mexico perfectly illustrates how countercyclical this business really is.
Yeah. So in January 2026, the Mexican government implemented a massive 13% hike in the national minimum wage.
Right.
Now, in almost any other retail scenario, a 13% wage hike is a disaster for margins. Your labor costs shoot through the roof overnight.
It's usually brutal for retail.
And the analysis confirms that EZCORP's same-store expenses in the region did jump by 16%.
They absolutely felt the sting of those increased labor costs. But we have to look at the other side of the equation.
Right.
Who is the core demographic walking into a pawn shop in Mexico?
It's the working class consumer.
Exactly. The exact same people who just received a 13% raise.
So because the customer base suddenly has more buying power, they're spending more in the stores, it is essentially cost pass-through, but like supercharged.
The velocity of money increased. Yes, EZCORP paid more to their employees, but their customers had more cash in their pockets. Because of that, retail sales in the region expanded by 15%. And the loan portfolio jumped 23%.
That is wild.
People felt confident taking out slightly larger loans, or they had the extra cash to buy that used television they'd been eyeing. This dynamic drove their regional operating profit, their EBITDA, up 23%, hitting $21.4 million.
It's incredible. If you told a traditional retailer they were going to face a 16% spike in operating expenses, they would panic.
Total panic.
But EZCORP absorbed that blow and actually expanded their profit margins by 70 basis points. They used the momentum of a massive new business cost to generate record profits. Like economic judo.
Economic judo, exactly. It also highlights the unique seasonality of the Latin American market, which provides a very stable rhythm to their earnings.
Oh, so?
Well, sources note that in December, pawn loans typically drop off. This is because workers receive mandatory holiday bonuses, known as aguinaldos in Mexico.
Okay.
And they use that influx of cash to redeem their pawned items.
Which sounds bad for the lending side of the business, right? That you're losing loans.
It is a temporary dip in loan balances. But that exact same influx of holiday cash causes retail sales to spike massively. The customers come in to get their watch back, and they end up buying a video game console for their kids on the way out.
So it perfectly balances the books.
It's a completely self-stabilizing ecosystem.
Man, their success in Mexico has clearly given them the confidence to redraw the map entirely. Armed with that $469.5 million in cash, they're going on a strategic shopping spree. And they're simultaneously dragging the entire pawn industry into the digital age.
Yeah, let's talk about that physical expansion first.
Yes, so in January 2026, they finalized the acquisition of Founders One, along with its subsidiary, Simple Management Group, or SMG.
EZCORP took an 87.7% controlling interest in that transaction.
That's a huge move.
Strategically, this is a massive inflection point. It added 105 stores to their portfolio overnight and unlocked 11 entirely new countries for them, heavily concentrated in the Caribbean, Central America, and Puerto Rico. They are bringing established local brands like Cashwiz and La Familia under their umbrella.
And the sources emphasize that SMG brings immediate earnings accretion, which, to drop the finance jargon for a second, means that the moment the ink dried, SMG's massive cash flow instantly hit EZCORP's bottom line.
Exactly. SMG generated $147 million in revenue back in 2024. So EZCORP is swallowing a highly lucrative operation whole.
And Puerto Rico is a particularly interesting addition, right? Because it introduces a high-volume market for auto pawn loans.
Yeah, auto pawns are fascinating.
People are literally using their cars as collateral.
Yes. And the ticket sizes on those loans are enormous compared to a standard consumer electronic or like a piece of jewelry.
I bet.
The borrower leaves the title and sometimes the vehicle itself in exchange for a much larger high-margin loan.
That's a whole different level of lending. But while they're physically planting flags across the Caribbean, the tech integration is what really stood out to me.
The digital side is where they're really separating from the pack.
Because a pawn shop feels very analog, right? But they rolled out this feature called Instant Quote for electronics.
It's a brilliant way to bridge the gap for modern consumers.
How does it work?
So a customer can use the EZCORP app or website to get a real-time, database-driven quote for what their specific laptop or smartphone is worth before they ever step foot in the store.
Oh, that's smart. It removes the friction and the anxiety of haggling at the counter.
Exactly.
They basically combined a Kelley Blue Book-style database with a pawn counter. And it's working, because their EZ Plus Rewards loyalty program just hit 6.9 million members.
6.9 million. Think about the data they're harvesting there for targeted marketing.
It's a gold mine. Plus, they've integrated this massive e-commerce system where their entire U.S. inventory is searchable online. The report showed that in the fourth quarter of 2025, their online payments hit $34 million.
No.
You can buy a vintage camera online and go pick it up at a local pawn shop down the street. It's a true omnichannel retail experience.
And to really appreciate why this strategy is so effective, we have to look at their biggest rival in the space, First Cash, which trades under FCFS.
Right. First Cash is the giant in the industry.
And right now, they are aggressively expanding into Europe.
Which sounds prestigious, but Europe is a highly regulated, mature market. I mean, they have extremely strict consumer protection laws and a very entrenched banking system.
The compliance costs alone in Europe are staggering.
Right.
EZCORP, on the other hand, is hunting in what strategists call blue oceans. They are targeting the Caribbean and Central America regions with high unbanked populations and very low corporate competition.
So they're basically running unopposed.
They're capturing markets where alternative financial services aren't just an option for a quick cash injection. They're often the only financial infrastructure available to the working class.
So if you're listening to this, you have to be wondering something. We just laid out a company that is printing money, breaking records, expanding its margins, completely immune to global supply chain shocks, protected by the rising price of gold, and successfully acquiring massive competitors. You would assume the stock is priced at a massive premium.
You'd think so.
But it's actually trading at a deep discount. There is a glaring disconnect between the operational performance and Wall Street's valuation.
This valuation arbitrage is the core thesis of this entire investment report.
Yeah.
Right now, EZPW trades at a 25 to 30% discount compared to First Cash.
That's a huge gap.
It is. If you look at the price-to-earnings ratio, EZCORP sits around 16.2x, while First Cash is trading anywhere between 21 and 25x.
Now, part of that is just size, right? First Cash is about 5 times larger by market capitalization. Large institutional investors and massive index funds naturally gravitate toward the biggest player in the room.
That's true. Size matters. But the sources point out that the discount runs much deeper than just market caps.
So what's the real issue?
It comes down to structural corporate governance. EZCORP has a dual-class share structure. They issue Class A shares, which are what regular investors buy on the open market. Those Class A shares represent about $1.68 billion in market cap as of April 2026. However, those shares have zero voting rights.
Wait, zero?
Zero. All the actual voting power is concentrated in their Class B shares, which are tightly held.
So the people providing the billions in capital have absolutely no say in who sits on the board or how the company is run.
None at all. And institutional capital hates that.
I can imagine.
Investors focused on ESG, which stands for environmental, social, and governance, pay very close attention to the governance part. They prefer democracy in their boardrooms.
Makes sense.
When major funds see entrenched management with absolute voting control, they view it as a risk. They demand a discount on the stock price to compensate for the fact that they can't force a change in leadership if things go wrong, even if that current leadership is performing exceptionally well today.
Okay, beyond the voting structure, the report also outlines some looming external risks, like the regulatory landscape is a constant threat.
Yeah, specifically the CFPB.
Right, the Consumer Financial Protection Bureau. They have a rule called Section 2171. It deals with requiring lenders to meticulously track and report data on small business loans to ensure fair lending practices.
But on the surface, you wouldn't think that applies to EZCORP. I mean, they do personal pawn loans, not commercial business loans.
Right, but the reality on the ground is different. A lot of independent contractors, landscapers, or independent entrepreneurs take their personal watches or even their professional tools into a pawn shop.
Just to get the quick cash they need.
Exactly. To make payroll on a Friday or buy supplies for a job. If the CFPB decides to classify those transactions as shadow small business loans, EZCORP would suddenly have to build massive software systems to track the demographics and business data of those borrowers.
And the compliance costs on that could be devastating.
It would completely mess up their lean operating model.
And we cannot ignore the inherent commodity risk either. We spent a lot of time talking about gold as a golden tailwind.
And tailwinds can reverse direction.
Exactly. If the macroeconomic fears subside and the structural bull market in gold crashes, EZCORP's scrapping margins will compress immediately.
That 34% margin would vanish.
Yep. Furthermore, the immense value of the collateral holding up their balance sheet will shrink, leaving them more exposed on those high-ticket loans.
So looking at all these factors, is there a genuine fear that this is just a classic value trap? I mean, it looks fundamentally cheap on paper, but if that dual-class voting structure never changes, and if the regulatory red tape starts wrapping around them...
Wall Street just leaves that discount there forever.
Exactly. Won't they just ignore it?
That is the crucial risk every investor has to weigh. However, the report provides a strong counterargument based on raw financial gravity. First, on the public relations side, management is actively defending their position to institutional investors by leaning into the circular economy narrative.
Because a pawn shop is essentially the ultimate recycling center.
Precisely. They recycled and extended the useful life of 5.6 million items in a single year,
That's a lot of stuff.
keeping literal tons of electronics and goods out of landfills. They're using that to appeal to the environmental side of the ESG mandates.
Hoping it softens the blow of their strict governance structure. Like, we might not give you voting rights, but we are saving millions of laptops from the dump.
Exactly. It's a clever pivot.
Uh-huh.
But the more potent defense is their capital allocation.
The buybacks.
Yes. To force the issue of the valuation gap, management authorized a $50 million share repurchase program.
They're looking at their massive cash pile and realizing the big investment they can make is buying up their own undervalued stock.
Right, which artificially reduces the number of shares on the market, forcing the earnings per share to go up.
Yeah.
Ultimately, the argument is that the raw, undeniable cash flow coming from the SMG integration in the Caribbean might simply overpower the structural discount.
The numbers will just be too good to ignore.
Wall Street analysts are clearly taking notice, setting target prices up to $34.21. That implies a 20 to 37% upside from the April 2026 prices.
The cash generation is just becoming too large for the market to ignore. Okay, let's step back and look at the whole picture here. We started with a business model that most of modern Wall Street dismisses as an analog relic.
Yeah, that antique clock.
Exactly. We explored how EZCORP has leveraged a harsh macro environment, the credit squeeze, and high inflation into a record-breaking growth engine. We unpacked how the surging price of gold provides a dual benefit, an ironclad safety net for their non-recourse loans, and a massive margin boost to their melting and scrapping operations.
And the Mexico paradox.
Right, the fascinating dynamic of the Latin American wage hikes, where a spike in labor costs actually triggered higher consumer spending and record regional profits. And we mapped out their aggressive $500 million expansion into the Caribbean, snapping up 105 stores while simultaneously driving $34 million in online payments.
All of this while trading at a deep discount to their biggest rival due to a quirky voting structure.
It really is a masterclass in building a counter-cyclical defense. They've engineered a financial ecosystem that not only survives when the broader economy struggles, but actually accelerates.
Absolutely.
But you know, when you look at that entire digital ecosystem we discussed, the apps, the instant quotes, the 6.9 million loyalty members, it makes me wonder about a tiny detail buried in the sources. EZCorp recently invested in an AI credit risk platform out of Singapore called Rich Data Corporation.
Oh, that's right.
Right now, pawn shops don't do credit checks. But imagine a future where those nearly 7 million unbanked and underbanked consumers aren't just giving EZCorp data on what kind of guitars or tools they pawn.
Oh, wow.
Imagine they become the foundation of a massive AI-driven alternative credit scoring system. What if the pawn shop of tomorrow isn't just a physical place to leave your watch for cash, but is actually the foundational database for the next big leap in global subprime fintech?
That's a huge thought. If they could successfully monetize that behavioral data and bridge those consumers into broader financial products, I mean, the entire valuation paradigm of the company shifts. It stops being valued as a traditional pawn shop and starts being valued as a data-driven financial infrastructure network.
So the next time you are cleaning out the attic and you see that dusty old clock, remember, sometimes the oldest mechanisms, when updated and plugged into the modern world, are the most powerful engines of all. Thank you for joining us on this deep dive into the source material. Keep exploring the hidden mechanics of the economy, and we'll catch you on the next one.